Class A office building is going to trade differently than a B and C, and Manhattan's going to trade differently. So last year, if you would have had me here at this time, people weren't willing to make those price adjustments. And now, when you're looking at valuations, they're looking to make some adjustments. Now, how much of a decrease is really the key there. And looking at the leases in place too. Is it a long-term lease, short-term? And so the valuation is the key of what everything is going to be driving at. Now we finally have some buyers and sellers who are willing to bridge that gap, because the sellers are obviously waiting for the higher pricing. The buyers really want those deeper discounts that they're willing to do.
Do we have a market? Could you say, what I understand is Class A in New York or Boston or San Francisco is holding its value.
Correct.
And doing well. B and C, some of the discounts I'm hearing 50% plus.
Correct, and it's also how far are you along on that cycle? Where are you with your debt on that? And so, are the banks pressuring you? I mean, the banks at this point have been doing the pretend and extend, because they want to keep it on their balance sheet. Now they're looking at some of those Bs and Cs and looking to say, do we have to get those off our balance sheets? And they're pressuring the owners of the borrowers of the buildings to really go and do some due diligence and making sure to see how long they can last with those buildings and seeing if they really need to start getting those off their balance sheets. And so the banks are putting some pressure, regulatory reasons, the whole host of things, for those buyers to start looking and making some adjustments for the sellers.
We also saw, I think it was yesterday, I think Goldman Sachs took one of the big buildings in Times Square, and SL Green is going to be the property developer, but basically the guys who owned it defaulted on loans, and then banks had to take control of it. Are we going to see that over and over now, or is this going to be like a one-off?
So those are great headlines. That's what people want to read, is those headline stories. You're not going to read the portfolios that were able to work itself out through the news because no one cares. But those are happening. And so those behind-the-scenes stories are happening day after day.
How do they get worked out?
So the banks will work with the borrowers, and they'll put in some provisions in there for plans. They'll look at their rent rolls. They're making sure that they can make those payments and trying to make modifications within those debts to make sure that the borrowers really can make the properties work. The banks don't want to see those headlines on distress. I mean, the banks don't want to go out of business, so they really want to make sure that they're working. And if they can make the cash flow work, they are going to work to modify those debt instruments for the lenders, or for the borrowers, I should say.
I have yet to have, or we have yet to have, because we focus on commercial real estate. Maybe we think about office too much, and we think about New York City, San Francisco office too much, because commercial is so much broader. But I want the person to come in here, maybe it's a family business, been in New York real estate for 150 years and said, we're done. We had B and C buildings on 3rd Avenue, and the banks are forcing us, and we're only getting 50 cents on the dollar. My 150-year family business is done.
Well, we'd never want that to happen, right? So we want to make sure we're working. It is not happening. Most of those are very lower. They're low leverage. If you've been holding those buildings for a long time, and those are smart cash flowing assets. And so they've been working those assets for quite a long time. You're not going to see a flood of deals. You're not. You're going to see the here-off bigger deals that you're going to be able to read about in the paper. But the floods that people were waiting for with all the capital to come in and rescue hasn't happened yet. And have we hit the bottom? I was away with a bunch of really, really smart owners and operators last week, and they couldn't agree if we've hit the bottom yet. And so it's just trying to figure that out.
So to that point, I guess it's a twofold question. One, why haven't we seen this flood of defaults like we were all kind of waiting for? And if we imply it's more on like a rolling basis where there's going to be these one-off buildings, et cetera, one-off deals, how long can that last for? Forever.
Great question. Wish I knew most of that, but again, it's part to deal with what the banks are willing to tolerate and how they can go in and do the modifications from a cash flow perspective. What people also are talking about is when you're looking to go in and purchase those deals and bring in the distressed capital, the distress isn't there, so it's really not as dire. And so really getting the people to understand what the valuations of those properties are and wanting to infuse capital to make those properties work. And so I think we're going to keep seeing the one-off for a little bit. Until we've really hit that equilibrium where the buyers and the sellers can, and we're almost there, can start making some real meaningful trades.
What are the good stories out there in commercial real estate?
Oh, that's nice.
There's a lot of good, thank you. There's a lot of good stories. So industrial's doing really well. Data centers are hot. Hospitality has come back. Hotels, great. Yep. People are traveling and doing that. Maybe a little bit nervous about consumer spending, people with that fear and what's going to happen with the report that just came out. But hospitality industry is doing remarkably well considering where we were, a few years ago. So there are some great stories and there's some great opportunities, but in every asset class, there's always a great opportunity for a great property with a really good vision. Why not take a great opportunity for that? So there are some exciting moments in commercial real estate.
So Paul has a 6% or over 6% mortgage rate, right? Straight up 6. So the big question is when does he refi? And he's like in the 5s, he'll consider it. I'm guessing it has to be in the lower 5s for you to really consider it. What kind of Fed cutting cycle do we need for things to make a lot more sense in your world?
So we're all anticipating, we talked about this before the session, we're all anticipating about 50 basis points in September for the Fed to reduce. We saw an alarming what people wanted an emergency, which is not going to happen. Again, the refinance is much different than the buyer market. So that refinance, I'm not sure Paul's going to get where he wants to go so quickly. But what should happen is that hopefully for people who are looking to sell, with the lowering of the interest rates, it'll make it a little bit easier for the buyers to come in and purchase those assets with respect to home building. Now remember, there's a lot more inventory now, believe it or not, than there were a year ago. There's been a surge recently of used homes, which are the homes that we've all lived in, and the home builders are having a little bit more of an influx of inventory for new units. What's interesting, though, is there was a study done for the median home purchase. The disparity now between rental and that mortgage payment is still $1,300 a month. 10-year average was $300 to $400 a month. So we got to get that a little bit lower to be able to make a meaningful difference there.